Welcome to the Gordon Asset Management Podcast.
It's remarkable.
Yeah, this is for the G's and the geeks, especially the G's who are like,
A show for savers, investors, and entrepreneurs, helping you to stay informed, invest wisely, and achieve the unimaginable. Now, on to the show.
Welcome, everybody, to the Gordon Asset Management Podcast. This is your host, Todd Zempel, and today on the podcast, we invited Ira Carnahan. Ira is on the portfolio management team for Rowe Price, and we invited him on the podcast today to specifically talk about one of our favorite balance funds, the Rowe Price Capital Appreciation Fund. So without any further ado, let's go ahead and jump into it. Ira, first, I wanted to start by saying thank you so much for joining us today. Clients of the firm, listeners of the podcast, I'm sure they'll appreciate your insight. If you don't mind, let's start, if you could, just share a little bit about yourself and your background.
Sure thing. So I've been at Rowe Price for 15 years now. Most of that time, I was actually an equity investment analyst for the firm, covering consumer stocks. But about 3 years ago, I moved into the current role where I a little bit more of a kind of a spokesman for a number of our portfolio managers. So kind of handle kind of communications with some of our larger clients to tell them what we're up to. And I work on several of our strategies, our capital appreciation strategy, our dividend growth strategy, our large cap core strategy, and our what we call U.S. structured research strategy, which is the analyst run fund. So again, been doing that role for about 3 years. Before I came to Rowe Price, I worked as a financial journalist. So I worked for several years as an associate editor at Forbes magazine. Prior to that, some various jobs in journalism. And, before that, I had done my undergraduate business work at University of Pennsylvania.
Very good. Now, Ira, the main reason we invited you on the podcast today is we wanted to talk about your capital appreciation strategy, which is one of our favorite balance funds, as I mentioned on the opening. Can you share with our listeners a little bit about that strategy and what it is from a very high level perspective?
Sure thing. So the capital appreciation strategy, there, I guess a few key points I call out about it. First, it's a multi-asset strategy. So, most of the strategies that we have at Rowe would be stocks or bonds or whatever asset class. With capital appreciation, on the other hand, we invest across multiple asset classes and have the freedom to shift our allocations around, basically depending on where we're seeing the biggest opportunities. So a typical allocation for us would be maybe 62% of the assets in stocks, and then the rest in fixed income and cash. Okay, so that multi-asset character is important. A second thing is what we think of as our investment objectives is a little bit different than a lot of strategies. So you look at a lot of investments out there, and the goal is outperform the market or outperform whatever benchmark you have. We're a little different. We have three different goals that we're trying to hit in capital appreciation, and we're trying to hit all of them. And the first goal, what we think of as our short-term goal, is to outperform the stock market on a risk-adjusted basis year in and year out. Okay, and in fact, if you look over the last 20 years, we've done that 19 of the last 20 years. So that's what we think of as our short-term goal. Our intermediate-term goal is, we think of the intermediate term as a 3-year horizon, and our goal over that horizon is to, at a minimum, not lose our clients' money, even if the market goes down a lot. Okay, so we think of that as sort of the capital preservation part of our mandate. And then the long-term goal over a full market cycle is, we want to outperform the stock market, and we want to do so with a lot less risk than the stock market. And in fact, if you look over time, we've typically delivered 105, 110% of the stock market's return while taking about 70% of the risk. And so that goal of strong returns with very tightly controlled risk is our long-term goal. So those are the things we're trying to do. We've historically managed to deliver pretty well on them through a combination of, again, the asset allocation I talked about a little bit earlier, but also, even more importantly, just the individual security selection. The vast majority of our time we spend on, kind of meeting with companies, digging into them, investigating them to pick, the ones that we think are the best bets. And we typically own about 40 companies on the equity side, so we're fairly concentrated. And I'm happy to talk a little bit more about what we're looking for when we pick stocks, but that's a very kind of big picture view of what we do in the strategy.
Very good. Yeah, let's go ahead and get right into it. So how do you view the world from a securities selection standpoint?
So, I think, sometimes if you step back and look how we're sort of categorized by, Morningstar, some of these, kind of other, kind of outside investment professionals, we're often viewed as kind of what's called GARP, or which stands for growth at a reasonable price. So there's a little bit of a growth tilt in our portfolio. We're looking for companies that are growing. Their revenues are growing, their earnings are growing, they're generating a lot of growing free cash flow. So we like to see some growth, number one, but we want to, very importantly, get that growth at a, what we think is a fair price, or ideally a significantly undervalued price. So we're growth investors, but value conscious. And, so we're not going to buy companies that we think might be, very temporarily undervalued, just kind of a trade. We're looking much longer term. We're looking out over, a 5+ year horizon when we're buying companies. And we want to see ones that, we believe are going to be able to, deliver strong returns for years to come, ideally. That's kind of what we're seeking. We try to take advantage of various inefficiencies that we see in the market when we're putting the portfolio together. And we don't actually disclose all of those inefficiencies that we're trying to take advantage of, because that's to some degree kind of our secret sauce. But I can give you a couple just to give you a little bit of a feel for what I mean by that. One thing we have found is that the stock market generally, investors, they tend to ignore the impact of events that are possible but aren't very likely. Okay, so to kind of give you an example, if there's maybe a 20% possibility that a company might be bought by another company, which is usually a very good thing for shareholders, the market generally just doesn't pay much attention to that kind of thing. If it's very likely they're going to be bought, the market's going to pay a lot of attention. It'll be priced in. But if it's below maybe a 1 in 3 chance, the market tends not to really price that. So if you look at our portfolio, we'll often, many of the companies we own will have some, probability, not high, but it's some probability of something really positive happening. And it's kind of free optionality that we're able to get, given, again, the market's inefficiency in pricing, things that might happen but aren't real likely. We've also found we're fixed income investors as well, bond investors, and we found that there are certain areas of the bond market that, again, we think are kind of systematically underpriced. In particular, and again, I don't want to get kind of too deep in the weeds here, but if you look at the different kind of ratings of bonds, we have found that bonds that are just a little bit below investment grade tend to be kind of undervalued over time. And that's partly because a lot of investors just won't buy bonds that are, below investment grade. It's also because if you look at, specifically at double B rated bonds, they tend to have very uneven patterns of returns. So they might actually have negative returns 3 or 4 years out of 5. But over a 5-year period, they'll actually be really good, because that 1 or 2 years they're good will be really, really good. But average investors, that's not something they want. They don't want to have 3 or 4 years where they're, maybe having a negative return. We don't care about that. If it's a good return long term, we'll do it. So, to kind of step back, what we're trying to do in our fund is to take advantage of some of the psychological kind of biases and quirks that many investors have. And again, by taking a long view, we're able to kind of capture some return that a lot of investors, aren't able to for one reason or another. So that would just be, again, a couple of examples of some of the again, kind of psychological quirks of investors that we're trying to take advantage of.
Now, when we look at other multi-asset strategies, balanced funds, target date funds, I think there's two camps of people in terms of how they manage fixed income. We have one population that uses the fixed income, the bonds, as a source of alpha or outperformance. So they're sort of shooting for the moon in that bucket. Then we have this other camp of folks that really want that to be the ballast. And so they don't want to take any risks with the fixed income. Where do you guys fall on that spectrum?
Right. So I would say that, we are willing to take risk on the fixed income side in certain senses. Now, I'm going to talk to you in a second about the risk that we take, but I want to preface that by saying, we have actually, since David Drew, our manager who's been running the fund since 2006, we have never, since he's been running the fund, lost money on a default on any fixed income security. So, I think the core starting point is anything we invest in on the fixed income side, we want to have a lot of confidence that, we're going to, at a minimum, get our money back. And so again, we've never lost money on a default in over 14 years now. So in that sense, we're very, very conservative. On the other hand, we are willing to stray for sure away from, say, just the very, very safest securities, such as, say, treasuries. And in fact, if you were to look at our portfolio right now, we don't own any treasuries. Okay. And in fact, we own very little investment grade corporate debt right now as well. And so, when you talk to the typical person, they might say, well, those are the safest areas of the fixed income market. So you don't own any of those, or you just, kind of taking wild risks. Well, again, that's not the case. As I mentioned, we've never lost money on a default, but we definitely do stray from, kind of the benchmark holdings in treasuries, say, or investment grade. And where we're seeing the biggest opportunities right now is in what are called bank loans or leverage loans. And so these are fixed income securities actually aren't fixed. So basically they're adjustable rate securities. These are loans that banks have made to various corporations that have adjustable rates. And why we find these so attractive right now is that we do think there's going to be upward pressure on interest rates over time. And for fixed income, generally that's a bad thing. But with adjustable rate securities, you don't have that vulnerability because, again, the rates are going to adjust upward. So we're protected if rates were to go up over time. So again, if you look at our fixed income portfolio right now, the bulk of it is in adjustable rate bank loans. And again, that's something that can shift over time. There have been times where we've had significant treasury holdings. There have been times where we've had significant corporate investment grade. So we're going to, again, be flexible, but we won't always be buying, the very ultra most safe securities because, at the end of the day, we're not going to get much return. At the same time, paying a lot of attention to risk.
So Ira, on the bond side, would it be fair to say that a lot of the price appreciation you're looking for is if some of these lower rated bonds get re-rated and upgraded? Is that a big component of the return at this point?
That can definitely be a significant piece. We bought a lot of debt, high yield debt, in Netflix a couple of years ago. And I think, part of the thesis there, part of the thinking, the rationale for that purchase was, look, this is a really large, successful company. Doesn't really make sense that they should be trading sub-investment grade. And, we think they will get upgraded over time. So that can absolutely be part of the thinking. At the same time, though, we're looking for securities where, we just have high confidence that, they're going to be able to pay the coupons. And, if they do, we're going to get a solid return. I'll say just one more thing about how we think about fixed income. I mentioned earlier, our three goals in running the portfolio. So we've got this, kind of short-term 1-year horizon, 3-year goal, and then a kind of long-term goal. If we were only focused on maximizing, very long-term risk-adjusted returns, it's not clear we would own any fixed income at all, right? Because, over long spans of time, you tend to get really, the strongest returns from equities. I mean, that's been the case historically. But what we're trying to do for our investors is not only give them strong long-term returns, but make the ride, between here and there, here in the next 20 years, make that ride not overly bumpy, right? Not make it overly difficult for investors. And in order to do that, we own some fixed income. So the role of fixed income, very big picture in capital appreciation, is to add kind of ballast, to add stability to our returns, to smooth out some of the ups and downs you're going to have on the stock side. And so we always have that in mind when we're thinking about what we want to own in fixed income.
So switching gears, I'm curious. I'm looking at Morningstar data. I think it's only through February 28th. From a equity side, you look like you're about 3 times overweight the category in utilities, and you do have a larger overweight to financials. Do you want to comment on those 2 sectors?
Sure thing. So, first of all, adjusting our weights across the different sectors is another way that over time we've been able to, generate some alpha, add some additional return for investors. So it is something we give a lot of thought to. And in utilities in particular is our favorite sector right now. Financials has been our second favorite. So first, to take utilities, I think we look at the utility space as one where there are really a lot of we kind of think investor misconceptions around utilities these days. So if you look historically, the return to investors in utilities has basically come just from the dividend yield, of the stocks, and there hasn't really been any growth to speak of, earnings growth. It's just been historically dividend yield. More recently, that has changed. You've got a lot of utilities out there that now are kind of growing, able to make a lot of investments, are really growing earnings significantly, and so I think, again, a lot of investors may think of utilities as old, kind of boring. You just get the dividend. But today you've got significant earnings growth as well. So we've got a basket of utilities in the portfolio that we think can grow earnings per share 5, 6, 7% a year for long spans of time. At the same time, have dividend yields of 3% or so. So you're getting, something like a 9, 10, 11% total return from these utilities. Again, we think over several years. You combine that strong return with the real steadiness of the utility industry, and you combine that further with all the trend we see today toward renewables and alternatives on the electricity front that are going to be a real boon for a lot of utilities, and we just see a very attractive kind of low risk area to invest in. And it's also one that has frankly been left behind over the last year plus, where investors have been kind of focused on other kind of sexier areas. And so I think the valuations are attractive too.
Over time, what we've noticed recently is that, I was going to say today, an announcement today, we saw Nextera and Duke Energy along with Wells Fargo are going into some big solar joint venture. But it seems like Nextera has been like a poster child for what you just said. And because they've been growing a lot in renewables, and they happen to be in Florida where everyone's moving, especially from New York, but they've been trading north of 30 times earnings. I was wondering just at what point does a multiple for a utility, no matter how growthy they are and are trying to be, does that reasonable price aspect of buying growth become a non-starter?
Yeah, no, and I think that's a really good point. So Nextera, as you said, has been kind of the poster child for the, kind of growth alternatives exposed utility, and really a big investor favorite. And so yeah, I think when we start seeing multiples like that, you gotta look really hard, even if you like what the company is doing a great deal. But there are a lot of other utilities out there that aren't kind of quite as kind of hot right now that still offer a lot of those same characteristics. But yeah, no, everything's got a price, and I think your point's very well taken on Nextera. But again, there are a lot of them out there, and it's an area that again we see as relatively low risk, particularly if you're paying a lower multiple. On the financials, that's another area that we've been overweight First of all, we have actually not been significantly overweight financials prior to recently. You have to go all the way back to the great financial crisis in 08, 09 when we last had a significant overweight there. When there was a lot of dislocation. We did build up a significant overweight this past summer. And the idea basically was that some of the big financials, some of the kind of big traditional banks had really lagged a lot. The stocks had really lagged, and yet the companies themselves, we felt like were really in a position where things were likely to get a lot better for them. Investors were likely to get more enthusiastic, and there were several things we thought could happen and are happening. First, you look at a lot of these big banks, they had made taken huge kind of provisions or made allowances for large credit losses as a result of kind of exposures due to COVID. And our analysts felt like, the reserves they had taken were much larger than they were really going to need. And so, we thought that would be a source of some earnings surprise. And that, I think, is turning out to be the case. We also looked at a lot of the big banks and felt like they've been under really strict regulatory scrutiny, not allowed to buy back shares in many cases or kind of grow their dividends. Again, the view was that the kind of restrictions were going to ease up. Again, we're starting to see that. That's been very helpful. We also felt like interest rates, again, kind of looking back to where they were, a few quarters ago, that there was likely to be some upward pressure there, and that would be a real tailwind for the big banks, if interest rates went up. And again, we've seen a little bit of that. So again, just kind of a sector that was out of favor, hadn't done well for a good while, but the possibility of a lot of good things happening. And again, I think we've seen some of that develop. So that's kind of been the broad thinking with our investment in financials.
Now, Ira, in 2020, you guys entered the year with a significant underweight to equities, which midpoint through the year, you transferred that into a significant overweight into equities. What was the deal with that? Did you guys have a crystal ball? Did you see this COVID crisis coming? What was that process?
Okay, well, first of all, no crystal ball, alas. We're always looking, but no, did not have a crystal ball there. We did not see COVID coming. We're certainly following it all, as the news developed, but we were surprised, like everyone else, it kind of how dramatically that became a huge problem and how quickly. But what we had, as you mentioned, we were actually very conservatively positioned going into COVID, and that wasn't an accident or luck. That was based on our assessment that the market at that point was pretty fully valued. It was tough to find really attractive investments, and when you're in that kind of situation, you've just got a lot more downside than upside potentially. So we were. Again, as a result of just feeling like, everything was pretty fully valued, hard to see anything really positive happening near term. As a result of that thinking, we were conservatively positioned. So as it happened, when COVID came along, we were able to, withstand that relatively well compared to a lot of investors. Fast forward a little bit, COVID develops, the market goes into free fall, drops 35% from kind of where it had peaked. We reversed course as that happened and tried to take advantage of all the, frankly, kind of the fear that was out there. And so we definitely invested aggressively, took a lot of, took a lot of money from cash, which had, peaked at around 20% of the portfolio, took that down to about 2%, and then put all that money into stocks. And so that was a really important factor in how we were able to deliver good performance during the year. So I think if at the end of the day, as investors, you have to be willing to step into some uncertainty. And we did that with the case of COVID. We invested a lot of money in stocks when everyone was very fearful. We certainly didn't do it blindly. We did just countless calls and consultations with health experts, with disease experts and so forth, to get a sense of how COVID might play out and very importantly, how the vaccine development might play out. we came away from all that with a lot of confidence that vaccine development was going to proceed a lot faster in this case than it had historically. And again, that was important in giving us kind of the conviction to step in. But it was it was an important decision we made. And if you think then kind of what's happened since, well, the market has obviously kind of exploded upward in the last few quarters. And what we've done in response is kind of gradually kind of let up on the equity exposure. So we went from being way overexposed versus our neutral in equities to now we're kind of typical exposure. So as prices have gone up, basically we've gotten a little bit more conservative.
Thanks for sharing that. And obviously anybody can go look up the historical performance and just see what a good job you guys have done relative to the benchmark and as well as other balanced funds out there. But now to switch gears, we are in this very interesting environment right now, coming out of the COVID-19 crisis, unprecedented levels of monetary stimulus, fiscal stimulus, potential for infrastructure, all these things. We expanded the monetary supply by over 25%, but really, we're not seeing as much inflation as what a lot of people have been calling for. Now, does T. Rowe Price have a company stance on what you're expecting with inflation?
Yeah, so one of the things that's interesting, and I think a strength of T. Rowe is that we don't have house views on whether it be on kind of macroeconomics or the market or sectors and so forth. We have a lot of folks who are very smart, very knowledgeable about their different areas. They share their ideas, but we don't force everyone to kind of reach agreement on any of these issues. And so we don't have a house view, I wouldn't say, on inflation. I think if I look at David's view, David Giroux, who manages Capital Appreciation, I think we felt like for a long time there have been some strong deflationary pressures with the broad kind of global economy and all the trade with China, all the kind of standard kind of reasons you hear out there that have been restraining inflation for a long time. And so we've seen obviously very little of it for a long time. As you said though, there's been a ton of stimulus kind of on the monetary side and now on the fiscal kind of spending side and kind of in the pipeline. And so I think we would agree that that's going to tend to kind of encourage some inflation. The tough question is how much and kind of when. And on that, again, I think the market generally has been very kind of unconcerned with inflation. You certainly hear a little bit more about it now, but if we think back over the past few quarters, there's been very little concern at all. And I think we felt like there has been some risk of inflation increasing, and that folks were generally kind of underappreciating that risk. So again, you kind of come back to our fixed income allocation, the focus on adjustable rate securities. Part of that is again around concerns that we might see a little bit of inflation. And I think at this point today, it's kind of TBD. We will see. I don't think anyone has a great record predicting what's happening with macro variables like inflation, but we do recognize the possibility that there could be some, and kind of positioned accordingly. The great bulk of our focus, though, just kind of day to day, hour to hour, is really on analyzing individual securities that we're thinking about buying or that we already own. At the end of the day, it's by doing that. That's where we think we have the biggest competitive advantages, understanding the companies better, as opposed to trying to call, some of these big macro variables. It'd be great if we had a crystal ball on those, but the reality is that's it's really tough to have an edge on that. So we want to make sure we're not going to, get burned if there is some inflation, but we're not kind of positioning the portfolio with a really precise, expectation of what might happen there.
So Capital Appreciation, this fund that we like so much, this balanced fund, how should investors view this fund? Is it a one-stop shop type investment? Should investors use it for a core satellite asset allocation? From T. Rowe's perspective, how should investors use this fund?
So I think we have investors who take both approaches. I could tell you that, I'm someone who's been involved with capital appreciation, for many years, and I actually the approach I've taken is I have all of my money that's not in T. Rowe Price stock is in capital appreciation, nothing else. My parents are retired. 100% of their money is in capital appreciation. So I think, and if you talk to a lot of folks at T. Rowe on investment staff, a lot of them own capital appreciation in a really big way. And so I think it absolutely can function as a one-stop piece, because you've got the exposure across a bunch of different asset classes, the focus on risk control. So I think it's very well suited to that. At the same time, some other folks will choose to make it maybe kind of the core of their portfolio, but then have some more specialized funds to supplement that. And I think that's fine as well. But it's absolutely intended to be a one-stop solution if investors want to use it that way.
That's an interesting comment you just made, because many of our 401k participants, especially highly compensated owners of firms that have generally large account balances, maybe approaching $1 million or north of $1 million, is that we've kind of had them in a core satellite type of allocation for most of the last 3 to 4 years, with the core being your fund in question, and then maybe seeking a little alpha around the edges. But that's good to hear that you got all your money in the fund, and except for the T. Rowe stock, which hadn't been a bad place to be either.
Yeah. Well, if you think about it, like this is a little bit of a tangent here, but if you work in the investment business or kind of financial services generally, you can think of your salary or your comp is it's kind of like a stock, right? Because it is, at T. Rowe at least, we're compensated substantially in stock, and then frankly, how the firm does depends a lot on what happens with the stock market. So you want to have a little bit of diversification in your other holdings, so that you're not kind of so levered to the stock market. And so a strategy like capital appreciation really kind of fits that well. And so the way I think if you can use capital appreciation again as your sole thing is have most of your money in capital appreciation, and to the extent you find that having all in it would be a little bit too risky for someone's taste, then they could just hold some cash, frankly. But anyway, again, different people take different approaches, but it's certainly we think again, if you were to look at the investment staff, all the different fund managers, analysts at T. Rowe, an awful large percentage of them have a significant amount of money in capital appreciation. We think it really is a uniquely attractive product.
Well, so that's great to hear. Now, again, this fund it speaks for itself, its performance and everything you've described today. But it's been hard closed since 2014. So what do you say to other people, friends, investors? Where can I put my money since your flagship appreciation fund is closed?
Right. No, that's that's an unfortunate thing. One of the kind of key management principles at T. Rowe Price is that we shut funds to new investors relatively quickly, because we don't want the amount of assets to grow to a level that it's going to kind of compromise performance for the investors who are already in the strategy. So as you mentioned, we closed capital appreciation back in 2014, so that isn't an option for most new investors. We have certainly a lot of other strategies at T. Rowe that are great. A few that I would kind of call out right off the top of my head. We have a strategy called New America Growth. Actually, it's just being renamed right now, and I don't know the name off the top of my head. I apologize, but it's run by Justin White. Very strong kind of multi-cap growth strategy that's had great results. We have a very strong global stock fund that I think a lot of our folks internally own as well, managed by David Eiswert. I think is a really great choice, superb record, And I know a fair number of people, again, internally at T. Rowe who own Capital Appreciation and Global Stock. We have great mid-cap funds. Unfortunately, both closed right now. We have some small-cap funds that are still open. Our small-cap strategy, our small-cap value strategy, and again, we have several great large-cap strategies. So I don't want to kind of just list off a whole bunch, but I think we have at the end of the day, what's underlying all of these strategies, whether it be Capital Appreciation or some of these others I mentioned, it's our research platform. And again, that's our kind of number one competitive advantage. So they're all kind of working on behalf of these strategies. Just one more I'll mention, just because it kind of fits the profile of Capital Appreciation in some ways, in terms of kind of lower risk, but a focus on companies that are growing, would be our dividend growth strategy managed by Tom Huber. Tom's been managing it for 20 plus years, has outperformed the S&P by an average 2 percentage points a year over that period. And again, a much lower risk strategy than, say, an S&P 500 index, because it's focused on companies that pay dividends. So those tend to be more established, less risky. So that'd be another one I'd definitely highlight.
Well, Ira, thank you for joining us on the podcast today. If anybody would like more information about T. Rowe Price or any of the funds we talked about, you can visit T. Rowe's website at troweprice.com, or feel free to reach out to our firm, Gordon Asset Management, at wealthqb.com. Thanks a lot, everybody. Have a great day.
My raps are raw. I dribble like a basketball. Slobber on myself, but that's not all.
Thanks for listening. If you enjoyed the show, be sure to click subscribe. Gordon Asset Management, LLC is a registered investment advisor. For more information about our firm, please visit wealthqb.com. The information in this podcast is presented for educational and entertainment purposes only, subject to change without notice. Opinions expressed are those of the participants and don't necessarily reflect those of Gordon Asset Management, LLC, its producers, hosts, or guests. Information presented should not be construed as tax, legal, or investment advice, or a recommendation or solicitation for the sale of any product or strategy. Listeners are encouraged to seek advice from qualified professionals to determine whether any information presented may be suitable for their specific situation. Investments involve risks. Neither Gordon Asset Management, LLC, nor its podcast participants shall not be liable for losses resulting from decisions based on information or viewpoints presented on this podcast.
Well done, but I'm raps are raw.